Hi, good morning, everyone. Thanks for joining us for today's weekly market call. Today, we have a few stock counter updates as well as technical analysis and the usual Singapore weekly for week 21. Yeah, so without further ado, let me hand over the time to Paul now. Paul, please.
Yeah. Thanks, Darren. I'm sorry, I'm outside in the DBS conference, so it's a bit noisy here. So the first one will be ComfortDelGro's results, first quarter update. So what the title just trying to say is that the inflationary pressures that they're having from higher bus driver fees and electricity is starting to abate. Yeah, next slide. So the results, the revenue was within expectations, but profit was below our expectations. So you can see from the table on the left what the weakness was on the public transport, but taxi did well if you look at the red bar. In terms of the positives, the taxi revenue continues to improve. It was still bogged down by weakness in China, because in China, although it has reopened year on year, last year, the first quarter 22, China was still operating as normal. The major lockdown was only end of 2022, end of first quarter 22. So for this quarter, they still had to offer incentives, especially in Beijing, to attract the drivers. So this was another drag to their taxi. Singapore recovery continues to occur. The other positive is for Comfort, it's not only just a rebound or improvement in profits, it's also a balance sheet story, because we continue to see record net cash for the company at about 700 million plus. For the negatives, the real weakness and disappointment for us at least was the Singapore operations. So what we had expected, public transport is basically bus and rail, which is the MRT trains and so forth in Singapore, and buses in Singapore and UK. So for us in Singapore, we thought the higher fares for train and also higher volumes for train could offset the weakness in bus contracting fees, which they highlighted more than a year ago, that they negotiated bus fees in Singapore lower and also higher electricity, but it was not enough. And I think that still dragged down or dragged down the earnings in Singapore, or at least kept it flat if you look at SBS Transport earnings. But the one that's pulling down the earnings, as was highlighted the previous quarter, was the UK bus operations. So in UK, what has happened is that the bus drivers have asked for higher pay. They have given them out in December, but for ComfortDelGro to claw back because bus, you're not supposed to take all these risks, it's a fee, but to claw back higher fees, you need to wait for indexation, which is higher CPI, and this will happen only once every year, so it will just take time, more meaningful in the second half. So that's why you can see the public transport earnings is really low, about 3% compared to the average last was around 8%. So in terms of outlook, we think there is still going to be, we expect improvement in the second half. What will come from, as we mentioned, the UK indexation, especially now UK CPI is about 10%, so you should get a jump of at least 10% in their fees. The other thing will be the improvement in taxi business. So effective 1st of April in Singapore, Comfort has reduced the rebates. So rebates last year was around 15%. Rebates, what we mean is assuming they charged rental for the taxi of $100 a day, rebates was $15. So now that has shrunk to $10 or 10%, roughly. If you move on to and the other improvement will be as they reduce the amount of incentives out of China. So if you look at our what we have done is that we lowered our profit 8%, and also we kind of reduced our target price, but our buying recommendation is maintained. Move on to the next slide. Next will be NBN Netlink Trust. So the earnings as usual is always stable, but what we are beginning to see is the higher interest rates are starting to bite the earnings. Next slide. So we move on to the earnings. Everything was within expectations. Not expected is very stable. The positives is that all the growth, if you look at the 7 million plus growth in the fourth quarter in revenue, most of it came from divergent revenue. Divergent is very low margin business, it's just cost plus. So divergent means if there's a new highway or there's a new MRT, then you need to move the fiber ducts underneath this MRT, then they get paid for that. It's more like construction activity, so the margin is pretty low. But that was where most of the growth came from. I think it was up almost 130%. Because last year, all the lockdowns, there's less construction workers, less construction activity. So for the negatives, the capex continued to did an increase, but capex I mean, if you go into the more detail, they actually can get to claw back the capex through returns. But in the near term, because of the higher capex, they have to borrow more, and then they have a higher interest expense. So you'll notice that the interest expense doubled to almost 5 million plus. But you'll notice that their average interest rate that they pay, which is still very low, is 2.1%. And one of the reasons is that although they have 700 million plus of loans, about 500 million was hedged at an incredible 1% to 2026. So although interest rates will hurt them, but the real impact will only come in 2026. So that's quite far away anyway. So in terms of the outlook, the main talking point now for Netlink will be the regulatory review. So just to recap, every 5 years, the authorities or IMDA will relook at the fiber rates that they charge households, because this is essentially a monopoly. So the government, the authorities will decide how much they can charge. So this will be discussed every 5 years. It should be coming out soon. It's supposed to be out early this year. But we think there'll be a modest decline in rates, and any impact will be quite minimal. Because although they've more, if you go more detailed, they have more users, so they should charge less. But at the same time, the WACC and interest rates, operating costs have all increased. So that's the reason. So for Netlink, we expect the distribution yield to be stable at 5.9%. And if you're looking for something that is low risk and you just want the yield, but this is like a bond, but equity type bond, then this will be the one on Netlink. So no change on our neutral. We raise our target price a little bit because we move our numbers a little bit more because of diversion revenue. Next slide. So next slide. So I'll move on to the usual weekly. So for the weekly, we got some data out of private property, residential new launch. So there was 800 over units sold in April. It's a very good number because this was the best in 7 months. But at the same time, this might be not a clear sign of the trend, because what we're seeing now is that there is a 27 of April, as we all know, 27 April, the cooling measures. So it'll be more interesting to look at the main numbers. Exports in Singapore continue to be very weak. So exports is down about 10%. And also electronics exports is even worse. It was down about 23%. So the external environment continues to be poor. We also look at China data now, because as we mentioned, one way to offset against the global weakness in demand or slower global growth is probably one uncorrelated source of return will be from China. So when we look at China, there were some very good numbers from the retail sales, although it kind of disappointed the market because comparing against the lockdown of last year, but still a very good number. If you exclude last year and you look at 2021, it's still a 5% growth. The weakness in China now is mainly property market and fixed asset investments, which I won't go into too detail, but basically those are the weaknesses you can see from the data. In the US, another thing that worries us is that the retail sales in US continues to slow down. So it only grew about 3%, and this is the slowest growth in almost 3 years. So it's just another sign that consumer demand in the US is slowing down. If you want to know like what products, what are the US consumers not buying, is a lot of non-good sector. So you can see electronics is down, furniture is down, gasoline and so forth. But the other thing that's also where the US consumers are spending is, I think, similar to Singapore when we had the reopening. A lot of it is on F&B and healthcare, and also, I guess, groceries. Next slide. So in terms of our technical views, we are cautious on the market. We are cautious because mainly for 2 reasons. We continue to see increasing weakness in US consumer demand. But actually inventory levels, we don't have a chart here, but inventory levels continue to climb. So what we think the US economy is moving from excess inventory, then it now moves into credit weakness, because the credit is being put back, and then now we weakness in consumer confidence. So, and the second worry we have is that because inflation is high, and the Fed is not willing to respond, because in previous cycle when we have a weak economic conditions, the Fed will cut rate. But because inflation is high, the Fed will be much slower than in the previous cycle in lowering rates. And this could actually make the economic weakness drag further than before. So basically, that's why we're trying to see the negative spiral the negative feedback loop will continue so worse than in the previous cycle that we think. Of course, it will be a recession, but of course it won't be as deep as in the past. But just that the slowdown might be worse than expected. So, and of course, there's all this debt limit talk. So what we think is that there's also another negative is this, even if the debt limits go through, I don't think this will cause the market to rebound that much. So that's why we say there's an asymmetrical downside risk. So what we mean is that there's more downside than upside, basically in a nutshell. So if anything, if the debt limit doesn't go through, then you're going to see a huge downside compared to any upside if the debt limit talks in the US proceeds as expected. Obviously, it's very hard to predict because this debt limit has been raised almost 78 times since the 1960s. So it's hard for anyone to say this won't occur again. The other positive, there was one positive on Friday. Powell and Bernanke was in the conference, so they did hint that they are open to a pause because their monetary policy basically, or interest rates are getting more restrictive because basically meaning monetary policy is getting tightening now. So that's why they think they may not, it's beginning to be more balanced. In terms of our events, do look out for our LHN webinar that should be happening on the 26th. Thanks. Next slide. Sorry, just two more slides. I mean, just a quick chart. You can see that the China consumer spending is rebounding, and then what is big in China is basically property, and because of that, fixed asset investments are so weak. Next slide. This is my final slide. So you can see in the US, there are two parts that is weak. Consumer spending is weak. So you can see in the blue line continues to deteriorate. And on the left is basically corporate spending. So this is we call it durable goods, but basically it means corporates in the US spending on machines and anything durable, I guess longer term fixed asset investment. So you can see that all these are also weakening. So that is worrying us that the US economy is slowing faster than expected. Okay, I think that's it for me. Thanks, everyone.
Thank you, Paul, and good morning, everyone. So moving on to Airbnb, we had released its first quarter earnings report last week with the title Strong Performance, which was overshadowed by soft guidance. Next slide, please. So moving on to its first quarter results, overall, the results were within our expectations, with a revenue and PATMI coming in at about 19% and 6% of our full year 2023 forecasts. PATMI, it was on the lower side mainly because of the seasonality weakness. Like the first quarter is fundamentally the weakest as compared to the remaining 3 quarters. So in terms of its performance, total revenue, it grew by about 20% year on year and 24% in constant currency to about $1.8 billion. And this was mainly driven by the surge in its booking volumes. In terms of its bottom line, it reported a net profit of 117 million as compared to a net loss of 19 million in the first quarter of 2022. And it swung to net profit mainly because of higher net interest income. So jumping on to the positives, first of all, the consumer travel demand, it remained strong in the first quarter, mainly because its booking volumes, it reported a record high booking volume of about 19% growth rate year on year to about 121 million nights and experiences booked. And this was the growth was mainly driven by cross-border trips as the COVID-19 restrictions they have eased, and the travelers coming back to the urban regions. Also, the long-term stays of about 28 days or more, they remained resilient and accounted for about 18% of the overall total bookings volume, and mainly due to the flexibility of remote work. Moving on to the second positive, supply, it continued to accelerate on its platform. So the total active listings on Airbnb platform, they increased by about 18% year on year to about 7.6 million, and quarterly it increased by 16%. And this growth, it's mainly because Airbnb, it continuously improves its product enhancements to help support and onboard hosts, as well as hosts they looking out to earn for additional income by listing their own properties on their platform, Airbnb platform. So moving on to the negative, Airbnb, it reported soft second quarter revenue guidance. It expects revenue growth rate to growth of about 12 to 16% in the second quarter. And the slowdown, it's mainly because of tough comparisons, as mainly as in the second quarter of 2022, Airbnb, it had witnessed a pent-up travel demand, mainly because in the first quarter of 2022, travelers, they could not travel mainly because of the Omicron variant. And as a result, they had to postpone their plans to the second quarter. So, and also the another reason for the slowdown in revenue was that it expects lower average daily rates, mainly because of the business mix shift towards the Asia Pacific regions and urban regions that mainly have lower daily rates because of smaller apartments. So next slide, please. Moving on to the outlook for Airbnb. We already discussed that it had provided a cautious outlook in terms of its top line, mainly because its booking volumes are expected to be challenged. Meanwhile, in terms of its profitability, in terms of its adjusted EBITDA, the company, it expects to be flat year on year on a nominal basis, and it expects adjusted EBITDA of about $0.7 billion US. However, its adjusted EBITDA margin, it's expected to be on the lower side. It's expected to drop mainly because the company, it has plans to pull forward some of its marketing expenses from the second half to the first half of 2023. However, in terms of its full year guidance, company has not provided an explicit number for revenue or its booking volumes, mainly because of macro uncertainty. However, it did reiterate that its adjusted EBITDA margin is expected to be about 35%, which is in line to the previous year. So in terms of its valuation, we have upgraded the stock to buy from accumulate, mainly because of the recent drop in its price. However, we have lowered our target price to 143 from the previous 145, mainly because we have slightly reduced our revenue and EBITDA for full year 2023 by 2% and 1%, mainly because of a soft travel demand, as consumers, they have lowered their discretionary spending. So, however, overall, in terms of its long-term view, we believe that Airbnb, it's well positioned to benefit from the shift in alternative accommodations, as they are more family and group friendly, as well as it's a unique supply base, and it's a brand image that's leading to significant organic traffic to its website. So that's all for Airbnb. I would now like to pass on to Jonathan for C Limited. Thank you.
Thanks, Ambish. Good morning, everyone. So I'll just be running through C's first quarter 2023 results. Next slide, please. So overall, the first quarter revenue actually missed expectations a little bit, mainly due to a decline in gaming revenue. Earnings actually beat on better expected improvements in profitability, especially as they've been cutting quite a lot of costs lately. In terms of what really did well, Shopee started re-accelerating its growth on better monetization. So when you look at it, revenue growth for the quarter was at 36% year on year compared to 32% in the fourth quarter. At the same time, operating income was also up almost $1 billion US year on year. And this was mainly because they had a sharp reduction in sales and marketing expenses. Why it's important that Shopee growth is re-accelerating is because for the longest time, Garena was the largest driver of profitability and of revenue growth. But as Garena has kind of tapered back and started to decline a little bit, Shopee has taken over as the main revenue contributor. I believe right now it's close to 70% of total revenue. The second positive is that overall expenses continue to decline. So operating expenses were down 22% year on year. Sales and marketing expense was down 60% year on year. And we do expect this to continue. We expect operating expenses to remain relatively low compared to past years, mainly because of the company's efforts in cost optimization and their focus right now more on profitability on the bottom line. In terms of the main negative, like I mentioned earlier, top line growth is actually declining. And this is dragged quite significantly from Garena. So top line growth grew almost 5% year on year. This was down from the fourth quarter of last year of 7.1%. And it actually has been declining over the last several quarters. Like I mentioned earlier, Garena revenue was down about 53% year on year, mainly due to a sharp drop in bookings as well as weakening user trends. So their user base has actually stabilized, but it has been dropping quite significantly for the last 5 quarters since its ban in India in the first quarter of last year. But when you look at the quarterly paying users, which is quite an important metric that they use, quarterly paying users was down from about 10% to right now is about 7.7%. So there's a sharp decline in the number of users that actually were paying for the games. And why we think that this might continue is because instead of previously when you had 3 kind of pillars that were growing their revenue quite well, right now you've got only 2 pillars, Shopee and SeaMoney, that are growing, and then Garena that is going to continue to lag, just pulling basically overall growth down quite significantly. In terms of our valuation for Sea, we maintain a buy, but we reduce our DCF target price to $100 from $120. We cut revenue for this year and next year by about 9% and 12%. However, we did actually increase our PATMI and EBITDA estimates for this year, mainly due to profitability across segments. But in the medium to long run, we do think that margin expansion will be a little bit slower, and definitely top line growth will be a little bit slower, which is why we cut our target price. One of the big reasons is because Garena, or rather digital entertainment business, has about 50% operating margins. But when you look at Shopee and SeaMoney, e-commerce and digital finances, when you look at the companies that are leading in this space, the top end range of their margins would be about 40%, 30 to 40%. So it's going to be very difficult for it to hit the 50% range. So you've got this kind of as Garena starts to decline as a total percentage of revenue and total percentage of profit, we do think that so the margins will kind of be capped. It won't be able to expand as much as it was if Garena continued expanding. So that's all for C. I'll move on to my next counter, would be Spotify. We'll also announced their first quarter 2023 results. In terms of how their results did, pretty much in line with expectations. The key for Spotify would be their user additions. So in the first quarter, they added about 26 million user additions, which beat their own guidance of 15 million, so they beat it quite handily. It was also the record first quarter additions, or rather record additions for any first quarter in its history. And at the same time, it was also the second highest user additions for any quarter. So user additions really came in, significantly higher than its own guidance. And the positive points of this also was that there was an acceleration in MAU retention, which is multi-active users. So we kind of saw, you kind of see some stability in terms of user growth, and this is one of the reasons why users actually beat their own guidance. At the same time, MAU to premium, which is their multi-active. So multi-active users is basically users that use the platform for free, and then premium subscribers are those that pay a monthly fee for subscriptions. So we're seeing that the conversion rates are still healthy, which is important because it's the main funnel that Spotify uses to convert a lot of its free users into paying customers. And so as we see more and more users and we see conversion rates remain healthy and continue improving, it's a very good sign for the company, and it shows that they've got enough quality in their content at the price point that they have to retain and to convert a lot of free users. The second positive is that their operating losses were also better than expected. So operating losses beat by about 20%, mainly due to lower spend and reductions in their real estate footprint. The main negative would be revenues missed slightly, missed guidance very marginally. So they had 3.0 billion euros and it missed 3.1 billion euros they guided for the first quarter. The main reason for this was a 6% underperformance in their advertising revenue. At the same time, their premium ARPU, which are average revenue per user, which essentially is your monthly subscription prices, declined 1% year on year, but was still within its own company estimates. The main reason for the decline is because, firstly, they were a lot of users from lower monetized regions, and secondly, a lot of the users were actually switching to family and dual plans, which are actually cheaper per user compared to your single subscription plans. Next slide, please. Moving into their outlook and guidance. So the company actually guided for a continued strength in user additions for both MAUs and premium subscribers. You can see in this red box here. At the same time, they're also expecting to raise some of its prices in a lot of major markets at least once this year. So they should have a significant impact on both top and bottom lines. In terms of valuation, we maintain an accumulate rating, and we also raise our DCF target price to $165 up from our previous target price of $128 US. So this raise in target price is mainly to account for increasing user growth as well as a long-term pricing power that the company has. So that's all for Spotify. I'll move on to Grab's first quarter earnings. It's a Phillip on the ground because we don't actually cover Grab, so we don't have a rating on it. But overall, revenue came in at $521 million US, so it was up 130% year on year. But there was a fundamental shift in one of its business models for its deliveries business in one of their operating markets. So they shifted from being an agent of deliveries to being the principal. So essentially, they run the whole supply chain, or rather the whole delivery chain. And that's why the revenue jumped quite significantly. Without this change, revenue would have increased only about 60% year on year. The company continued to generate a net loss of about $250 million US. At the same time, they also reduced their incentives by about 30%, while GMV, which is gross merchandise value, which essentially is the whole basket of what users spend on the platform, was actually up only about 3% year on year. So this showed a little bit of weakness in terms of user spending, which kind of worried investors, and that was the main reason why the stock price kind of suffered a little bit after its earnings. I'll run through its individual segments. Deliveries came in at 275 million, so up 200%. But GMVs actually were down 9% year on year, mainly due to Chinese New Year and the Ramadan period, which was brought forward a little bit earlier. So Ramadan last year was actually more towards the second quarter of 2022, whereas for this year it was towards the tail end of the first quarter. And so that's kind of what impacted GMV. In terms of mobility, revenue did well. It was up 72% year on year. At the same time, it saw GMV increase 46%, mainly due to improvements in driver supply. And at the same time, tourism was kind of increasing. That's why you saw airport rides that were up 133% year on year. In terms of financial services, GMV was flat, but their loans volume actually grew about 45%. So revenue was up 245% year on year. In terms of their guidance, they didn't really change much of their guidance except for their adjusted EBITDA outlook for 2023, which was reduced by 28% to, I guess, an adjusted EBITDA loss of $215 million US. So as some of their incentives continue to decline, and that's something that the company is actually working on. Like I mentioned earlier, the 3% GMV growth is a bit concerning because it shows a bit less a decline in consumer spending on its platform. This kind of makes their path to profitability a little bit more muddy because they didn't really take on the severe cost-cutting measures like other Southeast Asian tech companies. Headcount declined marginally, but not as significantly as other companies like Sea and Tokopedia. At the same time, they're still using a lot of adjusted metrics like adjusted EBITDA and segment adjusted EBITDA in its outlook. So it doesn't really it's not, they themselves aren't really very clear on when they'll be able to turn a net profit. Yeah, so I guess that's all for Grab, for Phillip on the ground, and that's all for me. I'll hand it over to Darren for Cromwell. Thank you.
Yeah, thanks, John. Yeah, so for Cromwell, they released their first quarter results last week. So this is a Phillip on the ground. We do not cover them. So this is a non-rated. Yeah, so for Cromwell, it's 171 euro market cap. It's basically a pan-European commercial industrial logistics REIT. And the breakdown of their assets is on the right in the pie chart there. Light industrial logistics account for about 46% of their current portfolio, and 49% is office for now, and 5% is others. So for their first quarter results, the MPI grew 3.6% to 33.6 euros quarter on quarter. This is mainly due to the increase in the step up in their annual inflation indexation, the CPI's indexed escalation. Yeah, because the inflation was so high, that's why a lot of the escalation was quite high last year. So the DPU was down 5.8% due to higher financing expenses. The portfolio rental reversions remained strong at about 6.7%. So for the capital management front, all in debt, it rose from 2.38% to 2.7% quarter on quarter, but our ICR remains healthy at about 5 times, with gearing at 40.6%, and 84% of their debt is hedged. So for their portfolio occupancy, 95.8% is at 95.8% and is up 100 basis points year on year and unchanged for the quarter. However, the light industrial occupancy was strong at almost full occupancy at 98%, with 4.6% rent reversions. And this is a record low vacancies for light industrial light industrial assets across their key markets. And for the office occupancy, their portfolio came in at 89.1%. Because some of their office tenants they switched to the Grade A office, so this this helped to boost the rental reversions. So for the quarter, rental reversions were positive 8.1%. Yeah, and for their high annual indexation, inflation indexation, most of it is 100% of the CPI, but there may be caps for some countries. Like for example, the Netherlands, there was a cap. So as a result, it was 75% of the CPI increase, but most of it is 100%. So for their strategy going forward, they want to pivot to a majority light industrial to logistic assets because the demand there is very high, and they also want to shift or rather divest all the office grade B and C's assets to have more grade A office. So the potential future portfolio or rather the target is on the chart at the bottom. So currently you can see it's quite a mix, and then their goal is to have after redevelopments and the divestment strategies in place, they want to have a 40% grade A office and about 60% in the light industrial and logistics. And for the outlook, their cost of debt, they expect it to be around 2.8 to 3%, especially if the interest rates, the euro rates are around 4%. And their strategy now is to hold on for acquisitions. So they're not looking at acquisitions only. Their strategy is to divest all these non-core assets. And right now they have a dividend yield of 11%. One more thing to note is that most of their cost increase, right, they were able to of their OPEX, rather their operation expenditure, they were able to pass on to their tenants because year on year, like this quarter, they had 6 million of non-recoverable OPEX, and it was the same as the same as first quarter last year. So that means that all the cost increases they were able to pass on to their tenants. Yeah, so that's all for me now. I'll now hand over the time to Peggy.
Thank you, Darren.
Cover Glenn for Silverlake.
Hi, I'm Glenn is at a corporate event with Paul, so I'm his stuntman. Okay, let's start. The Silverlake Axis had the third quarter 23 results announcement. Darren, please. Thank you. Okay, the numbers came in below our expectations. The net profit was down while the revenue was flat. The positive of this set of results is the current revenue still rose 8% year on year, and they still have a very strong order backlog of about 1.8 billion ringgit, which is about the same as the first quarter, end of the previous quarter. Okay, The negative is that the OPEX or operating expenses has shot up. It has risen by 14% year on year. Most of this came from higher staff costs, financing, and as well as forex. Okay. And project-related revenue, which is primarily software licensing, was down 27%. Software licensing itself was down 65%. For the outlook, we still remain very positive on the Mobius platform, which they have. This is a cloud-based platform that allows them to enjoy subscription type of revenue. The clients need not incur capex, and there's a strong focus for this, strong incentive for them to sign on to this platform, especially for the digital products such as debit cards and credit cards. And also there's a potential to replace the legacy systems that some of these banks are hanging on right now. And for the order book, the Silverlake has managed to clinch 100 million, more than 100 million ringgit deal from one of the banks, which will give them at least a 30 to 40 million ringgit to book in this year. Okay. We will maintain our buy with an unchanged target price of 49 cents Singapore cents, but we lower our FY23 earnings by 7% to incorporate the higher operating expenses for this year. Thank you. I'll move on to the next one. BRC results came in reported the first quarter 23 results, which was disappointing, but we expect very strong pickup in the second half of this year. Darren, can you move to the next? Thanks. Okay. The results were only about 31% of our FY23 earnings estimates. Therefore, we had to cut our numbers. The shortfall was because there was a lower order deliveries. Construction sites the progress was slow as they have a mandated safety measures that they have to implement. That started in September last year and supposed to end by end of May, but somewhat has been somewhat lifted from April already. So it has lost about 5 to 6 months of deliveries delay that has impacted the first half numbers. Because of this lower their revenue, they therefore have to make it up. They make it up by doing more trading businesses. Trading business is a low margin business, so therefore it drags down the gross margin to 7.4%, and also net margin was down 3.7%. The higher finance cost is also another reason for the lower net profit. Finance expenses shot up by 170%, but there's good news down the road. Okay. What happened in this first half was because of the lower steel prices, they have actually managed to lower their net gearing by cutting on the inventory holdings. Net gearing is now down to 0.38 times compared to 0.76 times at the end of September. And because of the lower steel prices too, suppliers are giving them better credit terms. That cuts the need for them to engage banks for LCs, and that is a big cost. That is a big boost to their operating cash inflow that helps to lift the operating cash flow to 60.8 cents per share. The order books continue to edge up because they continue to receive orders while they couldn't actually deliver much during this half. The order book is now 1.42 B versus 1.4 B at the end of September. Demand remains robust. According to the BCA estimates, progress payment, which actually represents work done and invoice, will rise by 9 to 20% in this year. So we estimate 60% of BRC's order book is from the private sector, which are less volatile. That means the orders won't be cancelled, and payments are also more certain. So positively driving second half numbers. Next slide, please. Thanks. Okay, so our revised estimates is like this. last year have been a very record year, which is unlikely to be repeated. But this year's numbers will be 65 million and probably 76 million for FY24. We expect steel prices to stabilize for the rest of this year, which is also a 20.4% decline, year-on-year decline for the whole of second half. And based on this lower gearing as well, our DCF derived target price is reduced to $1.99. Let's move on to the next one, Singapore Airlines. We have not initiated coverage on Singapore Airlines, so I'm writing this based on Phillip on the ground. Okay, we all know it's a record year for Singapore Airlines. It's also a record year for many other airlines, Qantas as well as the rest, who have brought back capacity earlier than the other airlines. So a record earnings will lead you to think that it will not be going forward. You will not be able to repeat these numbers. And the earnings were driven by more capacity added. They had now brought it back to 80% of pre-COVID level. Passenger load factors was very strong at 85.4%. This is ahead of the 83% recorded in FY19, the pre-COVID year. Okay, and also during this FY23, they had a fuel hedging gain, 749 million, and they also enjoyed government grant until July last year. On the other hand, cargo was weak. Cargo kind of mirrored the soft global manufacturing and inventory adjustment. And there's also more belly hold capacity. As more passenger flights take off, they are able to take some cargo on the belly hold capacity. So overall, it actually lowers the yield for cargo. And cargo yield has fallen to 68.5 cents, but it's still higher than the pre-COVID level. The outlook, according to the advanced bookings, based on the advanced bookings on hand, the first quarter 24 will still be a robust period, driven mainly by China, Japan, and South Korea routes. These are the shorter haul routes, and which also typically generate command higher yield. So therefore, we don't see passenger yield falling by as much in the first quarter of 24. But going for the remaining 3 quarters of 24, the outlook looks challenging because of the macro headwinds on the long haul routes to the States and Europe. Also, other regional carriers are also restoring their capacity. Qantas say that they will bring back 100% of the pre-COVID capacity by March next year. So that will weigh on the yields and also load factors. And SIA expects to add capacity back to 90%, only 90% of the pre-COVID level at the end of March 2024. The cash outflow is also going to turn into cash outflow in FY24, because last 3 years they haven't spent much on buying new aircraft, but they're going to start doing so from FY24. So they're going to spend 3.7 B and 4.4 B for the next 2 years. And this is still lower than the pre-COVID level, about between 5 to 6 billion a year. And they will also spend another 3.4 billion for partial redemption of the MCB in June. So that will reduce their NAV to, we estimate, about $5.85 for FY24. The price has been running. We think the catalyst, potentially, the market is excited about the impending merger between the 49% Vistara, which they own, and Air India, which is currently owned by Tata Sun. Okay, the Vistara, as you recall, has been loss-making for SIA since 2013, and the total investment in Vistara has been about 1.1 billion Sing dollar. So with this merger, they're actually able to write back all these accumulated losses. They stopped the holdings, the book value of Vistara in the books has been written down to zero value in September last year. So now there's going to be right back 1.1 billion. And on top of that, SIA will inject 360 million to lift its stake in Vistara to 25%. this value the merged entity at about 6.3 billion. So after this, SIA will own 1/4 of this, so which means the implied value is about 1.6 billion for SIA. So there's a jump in so-called book value, but actually these are all accounting entries. The exercise will leave NAV by about 41 cents per share. And SIA has committed to invest up to another 800 million into the merged entity. So the one thing to note is the combined group pro forma first half 23 net loss was 1 billion Sing dollar. So the merged entity, which will command about 23% of the aviation market in India, is still loss making. We're not sure, and company and Air India has not disclosed what is their loss or profit as at end of March 2023. So our advice is to maybe you should look at the diluted EPS and the diluted NAV for assessing the value of SIA, because diluted actually accounts for the MCB, and technically MCB is a liability which has to be paid back at some point in time. So 372 is probably a more realistic number for the diluted NAV of SIA. And if assuming all the MCB will be redeemed at the current price, then this diluted NAV potentially move up to $4.56. Let me move on to the next. Okay, Marco Polo. Okay, Marco Polo had a results briefing which I attended. Okay. Marco Polo, as we all know, is an O&M service provider. The market price has been running. Market cap right now is 180 million. First half numbers were distorted somewhat by one-off events that happened in first half 22. So actually, first they started to include the revenue to consolidate the PT, BBR and PKRO from second half of 22. So first half 23 includes the contribution of these two units. And because of a debt to equity swap that was done last year reported included a gain of 9.2 million in first half 22. And so actually our advice is to look at the first half 23 numbers. This is a more normalized number for the company. Okay. And first half typically is also a weaker half for Marco Polo because of the monsoon season in the waters that they worked in. So second half is slightly better from first half. So roughly you could look at between 9 to 10 million net profit, just rough estimate. So the PE looks like reached at about 20 times right now. Okay. The key to this revaluation of Marco Polo Marine is on the CSOV. They are building a CSOV that costs 60 million, which is used for commissioning for offshore. It's a commissioning vessel for offshore wind farm, wind installation. Okay, there's currently it's their own design. They are under construction in their own yards, which will be deployed in the Taiwan waters for the offshore wind farm installation. So because it's deployed in Taiwan waters, it needs the co-owners who are Taiwanese, or at least have a carrier able to allow them to carry a Taiwan flag. So if they are now looking for co-owners, if they are able to secure, then they don't need to bear the whole 60 million cost. That will help them to deleverage. Then and if they own a 25 to 30% stake in this vessel, they are also able to book construction profit from the construction, and also ultimately raise their share of the renewable energy jobs. Okay, the outlook for them, they mentioned, is the offshore charter rates are still holding up, but they are signing a lot of short contracts. It's between 6 months to 1 year. So you can look at this from two sides of the coin, because if the depending on how the oil price is trending, the rates might not hold going forward. Okay. If the first CSOV gets off the ground, they have plans to build more to anchor their reputation in the construction of these vessels. So that's all we have for Marco Polo. I move on to the next Rex International. Okay, Rex, we caught up with the management. They are here in Singapore. They are all mostly Swedish, so they are based in Sweden. They will try to get them to do a webinar with us when they settle back down in their country. The market cap is 2 to 5 million right now, Sing dollar, and this is about 1 times price to book for the company. They have 3 producing oil and gas fields, 1 in Oman, 2 in Norway. The 2P reserves, I suggest you look at the 2P reserves, which is the proven and probable, but most likely it will have a higher chance of translating into P&L. Resources it's more further down the road. If it happens, it's good. If not, then they might have to do write-off. Okay, they are also reporting. They are also developing assets in Norway and Malaysia. FY22, they actually incurred a net loss because they wrote off substantial expenses in terms of depletion of the oil and gas properties and impairment of exploration and evaluation expenditure. Okay, this is what happened is what this oil and gas explorer does is that it's a drill or drop policy. So when they drill, they find nothing, or the prospect is very low, they will have to drop the field. And when they drop the field, then they have to do this write-off. So it's somewhat very uncertain. From our perspective, it's very difficult to project this these 2 numbers will be. And also in the same year, they also faced with higher finance costs. We did the back calculation. The cost of debt actually went up to 20%. The fossil fuel industry is actually just it's not able to get any funding, any meaningful funding from the bank. Okay. The adjusted EBITDA, which they suggest that we look at, is actually a proxy to the cash flow. It's also down 44.5%. Is because of the higher production expenses. In Oman, especially, there were some stoppages during the year, so they couldn't work the field. Okay, and more recently in March, they did a capital reduction of $168 million. There's no impact to the NAV, but it actually reduced the share capital of the company. They reported April production of 8,339 barrels per day. And I caution to read this number carefully, because Rex share of this is 7,650 barrels per day, because they own about 91 to 92% of this oil fields. And then if you look at the table at the bottom of this table, Oman reports the number as STB per day. STB is stock tank barrel. What it means is that it's the oil in place. It means what they bring the product that brought out off the ground, which also will have oil and water. So it's not, so this 4782 is not all oil. So we also not sure what is the percentage of oil and water. Every time they bring it up is always different. So assuming say 70% oil, then you still need to take away the government will offtake about 1/3 of that as well. So the net impact is not 4782. Okay. So the company announced 2 potential diversifications, which was quite controversial. They had a stake in the heavy duty drones company. They want to raise this stake to 53% and then consolidate it and pay another $4 million. They also plan to acquire 100% of Morosite. This is an related party transaction. They have a commitment to invest up to $43.2 million Swedish krona. Because it's a RPT, it will require shareholders' approval. This is involved in medical technology that will be need for clinical trial. The management thinks that the amount to be spent on clinical trial is not high, but there's no numbers given. Okay, and the outlook of the sector, the management sounded bullish, very upbeat. mainly because FY23 will see a full year contribution from the YME field, which they acquired at 10%. We have a 10% stake in the which was acquired late last year. Yeah. That's all I have for Rex International. I'll pass you on to Zane, who's with us today, and he'll give you the technicals. Zane, please.
Thanks,
Thank you.
Peggy. Good morning, everyone. So now I'll move on to the technicals. For S&P 500 last week, we finally saw a breakout following weeks of range consolidation. So we actually broke out of this consolidation triangle shown in chart. And we are currently retesting the 4,200 level, which was the resistance back in February this year. So for now, the market could reach into some form of resistance. But however, if we do continue the recent bullish momentum, I think the next key resistance will likely be at 4,320, which is the previous high made in August of last year. As for the current support, it's likely to be at 4,050 to about 4,130, where 4,050 is the recent lows posted in April and May, and 4,130 was the level that we actually broke out from last week. So that's all from me for now. I'll now pass on my time to the rest of my colleagues for Q&A.
Sorry, Darren, go ahead.
Sorry. John, would you like to start with yours first?
Yeah, sure.
Thanks.
Yeah, I'll take this question. It's a question: how do we compare Spotify with Tencent Music? So essentially, they're complementary because Spotify isn't available in China, and Tencent Music is more or less only China. What's interesting is that both actually have about 8 to 10%, or rather, Spotify owns about 8 to 10% of total shares in Tencent. And they had this equity investment deal between the two parties in 2019 or 2020. Yeah, but when you look at both of these companies, obviously Spotify is more global, whereas Tencent is fairly limited to just China and its territories. So, thank you.
Yeah, thanks, John. Yeah, so today I see there's quite a bit of feedback about our slides. I think some are saying that it's too small, and yeah, some are telling us to make the slides bigger and the charts bigger and have some pointers that when we're talking about the slides. Yeah, so yeah, all these feedback are taken into consideration when we do our slides. Yeah, so we'll try to improve on them going forward. Yeah, thanks. Yeah, okay, so regarding the question on CapitaLand Sanders REIT's private placement at $2.727. So fundamentally, is this considered positive or negative for existing unit holders? Technically, would you trade? Yeah, so the technical portion, I'll leave it to Zane later. Oh, but this is would you trade come dividend or ex-dividend? Yeah, so this may be a fundamental question. Yeah, so actually based on the private placement, it's actually at a 5.6% discount to around 5% discount to the VWAP, the previous day trading VWAP. So usually when companies issue a private placement and it will be at a discount. So because of this, most of the existing shareholders will get diluted. So in the near term, almost, or rather most of the 99.99% of the time, it will be not a good thing for existing shareholders, as there will be a new set of shares that will enter the market that at a lower price, that they entered at a lower price. So this will dilute the shares. So that is the upfront for near term is definitely dilutive, but in the long term, we have to see what they raise the funds for. So for this case, they actually raise the funds to acquire the Seagate property, and there's a portion of the funds is used to acquire the Seagate property, like 31% of it. Then 29% of it is used to partially fund another potential acquisition in Europe. So this is also a good sign that there's some transactions that might be coming back to the market, since we see some clarity that the interest rates at the Fed rate is kind of peaking, and yeah, then the transactions we anticipate it to come back in the second half as well. And 14.3% is used to redevelop a Singaporean high specs ramp up facility, and the rest is for debt repayment. Yeah, so for this, actually in the longer term is accretive deal. Like we expect this private place this acquisition to be about 0.7% pro forma accretive. So in the long term, it is a good deal, but in the near term, because of this this shares dilution is not really a good thing. But then so the question is, would you trade come dividend or ex dividend? Yeah, I don't really have an answer to that actually. Yeah, so yeah, I hope I answered your question for the CapitaLand or Sanders Street.
Okay. Thanks, Sarah. I'll take over.
Yeah,
Thanks.
thanks, Peggy.
Okay. There's a question on Netlink. Obviously, this is a Paul's coverage, so I'm just a stuntman here. Okay. Let me try. Have you a target price for 2023 for Netlink, and will there be growing dividends forward? Okay. Paul's Netlink's target price is 87 cents, which is, yeah, if I remember the slides correct, 87 cents. I haven't been able to look at his forecast, so I can't tell whether he's projecting growing dividends. Maybe we will answer this in the P3. We will post this question on P3 and Paul will answer it on P3. Thanks. Okay, then there's the other question. Okay, sorry. Hi Peggy, your voice is quite muffled. Can you speak louder and clearer, please? Okay, sorry about this. I'm in the office, so there's a lot of background noise. I try, so my earpiece is like from Taobao. Okay. 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 The next question is SIA. What is MCB? Okay, MCB stands for Mandatory Convertible Bond. Recall during the when the COVID hit, SIA issued 2 tranches of MCBs to raise about probably nearly 10 billion for the to replenish the cash flow. So these MCBs are due for conversion only in 2030. I mean, the holders of MCB cannot ask for conversion, but as MCB's conversion price will be adjusted downwards every time there is a dividend payout. So the latest MCB, the latest after the 28 cents dividend, we estimate the remaining MCB's conversion price has been lowered to $4.52. Okay, I hope I answered your questions. You don't have, if not, you can just send in another questions again. Thanks. Okay, the next question is also about SIA. How does the write back of Vistara's losses work? Would that mean that SIA would have to issue more equity? Okay, see, Vistara losses over the years was 1.1 billion. So now that they can use this 49% stake in Vistara and give it to in exchange for a share, a 19% share in the merged entity. The merged entity is Vistara and Air India. So therefore, so therefore they can write back the losses that they incurred, 1.1 billion. And if you look at, they inject 360 million for another 5.9% stake in the merged entity. That means the merged entity is valued at 6.3. So 6.3 times 0.25. So the SIA shares become $1.58 billion worth. That's why they can write back the losses of Vistara. And potentially they can also actually had some revaluation upwards of this. They will own 25% of the merged entity, right? And this value is 1.58 billion. So therefore, potentially there's also some more higher NAV creation as a result of this merger. Yeah. So actually these are all just book entries, but potentially you can bring up SIA's NAV by another 41 cents according to our estimates. This is not official numbers yet, right? Would that mean the SIA would have to issue more equities? Not for this one maybe, but they committed to inject another 800 million into this merged entity. They're going to spend another 3.5 billion for MCB redemption in June. They have another 3.5 billion more of outstanding MCB. And all the higher capex investment. So you can think of that the cash outflow for the next 2 years will be it's starting to be a cash outflow for the next 2 years compared to the net cash inflow that we have. So at the end of March, they had a net cash about 988 million that will turn to net debts from this FY24 onwards. Okay. Okay, next question is again on SIA. For SIA, is cargo or passenger more profitable, higher margin? If you look at the slide that I have, I was trying to point to that. Darren, would you bring back the SIA slide? Thanks. So if you look at the table, you can tell that passenger yield, that means every kilometer and the number of passengers, they earn 11.8 cents. But cargo, they earn 68.5 cents on load time kilometer. This is not a clear sign of which one is more profitable. But you multiply the load factor and the distance and the revenue, right? So you can tell that passenger is very important for them. So the cargo is not so, but cargo can potentially be higher margin, especially those carry on the belly hold capacity, because you have passenger on top, your cargo seat at the bottom. So you still fly the same route, you still use the same fuel. So the cargo could potentially be higher margin. I hope that explains your question. The next question is also SIA. Thanks for the SIA analysis. However, bottom line, what's our take on the future growth and price of the stock and yield? Earnings on net profit from 24 and 25, according to my rough estimate, is about 1.4 billion for 24 and maybe drop to about just 1 billion for 25. So profit is coming down. Okay, they don't have a dividend guidance. The yield, I believe you're talking about dividend yield. They don't have a dividend guidance. 28 cents looks like on the 38 cents for FY23 looks like on the it's probably going to be on higher end, because as profit fall, they don't expect them to maintain the same dividend per share payout. Yeah. Thanks. Okay. Peggy, you shared in Marco Polo that charter rates are still holding. Then what is your view on Samudara and Uni Asia, which also seems to offer charter services? Okay. Uni Asia is again Paul's the expert. Okay, but the difference between the three of them, because Marco Polo is oil and gas, they charter mostly for offshore oil support, as their vessels are offshore OSVs, offshore support services, support vessels. So the charter rates right now is for $1.20 per horsepower. The Samudara is more providing feeder services for containers. So it's a container freight rates, and that is very exposed to the global environment on more about the cargoes feeding from Asia feeding into the longer Europe and Asia and America, and cargoes coming back from or maybe empty vessels coming back from those places. So it's a container story. Uni Asia is about bulk carriers, and mostly handy size bulk carriers, the smaller ones. So the three are operating in different kind of types of vessels, and different the rates are also different. For Samudara, of course, the container rates, freight rates, we know is falling. Uni Asia, same thing for bulk carriers. It's also very highly geared towards the commodity prices. Okay. Yes, please give some views on Samudara prospects beyond 2023. They have been buying new vessels, mostly in the tankers and oil tankers, in the petrol products space. hoping to capitalize on the growing demand of oil and gas coming from Asia, going from Asia, feeding into Europe and maybe into China. So the very difficult for me to comment on what is the prospects. Maybe I can do more work and we come back into maybe the next webinar, or the future webinars when I can do some serious work on it. Thanks very much. Okay. There's another one. Can you comment on the outlook on oil and gas industry? Any comments on the dynamic? The oil and gas industry, the prices are holding right now. But the industry, of course, is also a function of a few things here. First thing is the reopening story for reopening of China, and will probably drive some demand for oil and gas in China. But also the sanction on Russia will also bring some Russian products into China and India. So the story is a bit mixed currently. I'm not quite sure how it will turn out, but looking at the oil prices, give us a guide, give us a clue that there's a that you have to take a bit of caution on this in this area. Some of the oil majors, you listen to the calls, you can tell they are all trying to pump up whatever they have very quickly in the next 10 years before the market grows for all these fossil fuel. And credit is not helping as well. The banks are not lending. So with the higher cost, cost for funding continue to rise for them, there's really a more urgency for them to do a lot more work right now to bring as much as possible, as much as they can from the ground. So that's the message we got from most of the oil companies and the support service providers. Dynamic is benefiting from a very strong market for FPSO. So the contracts are coming in quite strongly. But the yards are full though, so they have been outsourcing a lot of their orders as well to other yards, including Kim Hing. So the orders will still be strong, but there could be a capacity constraint on their part. Thank you. Just wondering if you have any comments on the outlook of Hopper, SETS, and SIA Engineering. Thanks. So sorry, don't have any idea, don't have any coverage on Hopper. Only drivers, the drivers for Hopper is really because of they hold a very significant stake in UOB. So if you look at an RNB UOB movements of UOB share price will impact them. That's all I have about. I know about Hopper. For SETS, SETS is a cargo story going forward, because once they finish after they complete the acquisition of WFS, about 50% of the revenue will come from cargo, and cargo outlook is not exciting. So the SETS earnings coming out next Tuesday, Monday night, I think. Could be it's the first time we'll see how much WFS will add or deduct from this bottom line. So and also how much gearing they will take up, how much more gearing they will take up for the acquisition, as well as absorbing WFS debt. They're in the process of refinancing WFS debt, but so they're trying to buy back all the outstanding bonds from from the WFS, the bondholders, but the bondholders are not budging so much. So they had raised the price for the buyback. So we generally don't see any catalyst for a set share price. They also have a joint venture with Vistara to provide the in-flight service, in-flight food meals at the Indian airport. That might benefit somewhat from if the merger of Air India and Vistara take place. So they will have a bigger share of the market. Because after that, Vistara's from a 9% market share, the combined group will have about 23 to 25% market share of the Indian market. SIA Engineering, I spoke about it 2 weeks ago, I think. The last set of results, the second half especially, was quite a disappointment, because without the job support scheme, they went into operating loss. The SIA Engineering has to if they are good for their work, but because they are so good, they actually cut down on the number of man hours they need for maintenance, for line maintenance. So they actually can do a lot more work now, but because they charge by man hours, so the revenue does not show on how good they are. So the going forward, it really depends on the number of flights that will be added on the Singapore Airlines, Singapore Changi Airport, because this is really the base for them to grow their business. And they are also looking to these 2 hangars in Malaysia, hoping to capture some of the upside on the Malaysia aviation sector. Overall, the outlook is not as exciting as I mean, it will not benefit as much from the reopening unless the flights start to gather more momentum at the Changi Airport. Yeah. Okay, this one I got to defend. Okay, Paul had been MIA for these 2 weeks. This is quite unusual. Is Paul in the midst of pursuing other career opportunities? No, Paul last 2 weeks has been at some other corporate events. Today he's at DBS Investor Day. So that is very important, because he'll come back with a call on the entire market. So yeah, Paul will be back with us next week. Is Sembcorp's price increase based on any fundamental, or is there a lot of hype about ESG favor which created a lure? Okay, Sembcorp, I think the market is there is a revaluation of assets that have a bigger renewable content, and Sembcorp definitely fit that after they sold off the India coal power plant. So now their renewable proportion percentage of their entire asset portfolio is much higher now. So it's definitely a stock that could be included in any of the sustainable portfolio by all the institutional fund managers. So yes, Sembcorp is enjoying that uplift. I leave the TA to Zane later. Okay, I can I take a rest? Is there any other question? Oh no, don't have. Okay, can let me continue. I hope you're not bored. Thanks. Why the jump in Hyaptong? Hyaptong gave a very positive profit warning to say that the earnings for FY23 will be March 23 will be very strong. And Hyaptong, is in the crane business. So crane has enjoyed a good uplift after the COVID lockdown and the construction starts to come back. Okay, the cranes are, there are two types of cranes, one is crawler cranes and tower cranes. And if you do PVC work, prefab work, you really need the tower cranes to bring the structure up to the top floors. So the crane operators have been enjoying a good demand. Can't say the same for building materials like BRC, because if you are doing the groundwork or you're just doing the finishing work, you don't need steel structures. But crane, especially for PVC structure, which is now the HDB mandated that you have to use PVC. So the crane operators have been enjoying very strong orders for their cranes. I hope I answered that question. Okay. Any view on ST Engineering and UMS? Sorry, I don't understand. I don't know ST Engineering well, so I can't answer for that. So I'm sorry I have to miss that. UMS, I think second quarter will still remain weak. Mainly because the orders are the customers' orders are still forecasts are still not strong. But they are still working on new first article. We call it first article, means the prototypes, which if the customer bring in the production orders, that will see the next year stronger next year, F24. So 23 might still be a weak year, weak year for them. ABSC, what do you see as a short-term and long-term impact on counters like CDL, UOL, and Quacolan? Okay, I'll try this one. It's ABSD. If you recall, the ABSD impact is bigger on the foreigners. They double the foreigners ABSD from 30% to 60%. So will impact the high end. Those are high end residential products. So for CDL is the one that is in CBD, that will be the new port residences that will be impacted. For UL and Quacolan will be not so much, because most of their product which have not been sold as more cater to the local population. So we but the worry right now is whether there will be more property cooling measures coming through. Probably not this ABSD, because the property prices continue to rise. It's rise faster than our income growth. At some point, the affordability will be affected. Thank you. Has Franken worst financial over? What's the technical? Oh, okay. Franken probably mirrors the other the other tech companies who are in the semicon space. So we still think that this year will be a very challenging year for them. I'll leave the technical to Zane later. I done everything. That's about it. Jonathan, would you have anything? Oh, sorry. This is me. This is mine again. The AI related stocks in the US are running high. Would there be any companies in SG that are related to AI? We think the I can't think of anyone that could have some exposure to this. I can think of users. I know APEC Realty said they're using AI to write their advertisements for property for their agents. But I don't know any companies that will benefit from AI right now. Yeah. Thanks. Should I pass this back to Zane?
Yeah, I think we
Oh.
can pass on the time to Zane for the technical portion.
Thank you.
Yeah, thanks.
Okay, thanks. Let me just share my screen right now. Okay, I'll begin. The first one is Keppel Corp. So I think Keppel Corp currently it is still in an uptrend over here, but recently it's moved a bit more sideways for now, given the strong gains. But the trend is still intact. I think for now looks like a bit of consolidation taking place. We see that the MECD is currently in a negative crossover for now. So for now, probably just sideways trading. Support is at around 630 to about 635, while the resistance to break is at 655 for higher highs to be made. Then the next one is Mapletree Pan Asia Commercial Trust. For this, currently, I think there was a pullback recently to test this uptrend channel support over here. Currently, we are finding some support for now. So if price is able to hold, I think we could be able to see some form of rebound. If we do clear up the 170 level, then I think the next resistance would likely to be around 175 for Mapletree Pan Asia. And next will be Agricultural Bank of China. So for this counter, I think currently the momentum has kind of slowed recently with a negative crossover at MECD. Then price is reverted back into trading into this uptrend channel for now. So I think for now, probably some form of sideways consolidation with the support around the $3 mark, while the resistance likely to be from about 317 onwards to about 325 over here, which is the channel resistance. Okay, for the US TA, I'll cover it later if time permits. I'll go through the Singapore and Hong Kong counters first. Okay, next one is iFast. I think for iFast, we've seen price pull back recently, but however, price has seemed to form a little bit of a sideways direction recently, at currently finding some support at the $4.15 level. Currently, the MECD is showing a first bullish crossover today. If that holds by the end of the day, I think we could see some form of rebound if the price is able to hold at this level at the end of the day, since price has started to form a bit of a sideways pattern after the sell down recently. Resistance wise, I think we could be looking at around 444 around here, upwards to about 457 currently, which was a previous horizontal support that we broke down off recently as well. There's also this trendline resistance to take note as well if price does rebound to these levels. Okay. Next one will be Genting Sing. So for Genting, I think we are near the support, even though the price has sold down recently. So with the sell down last Monday, we actually broke down on this downtrend channel over here as well. Then currently we are near the $1. Previously, $1 was a strong resistance level. Currently we are seeing support at $1.01. So I think for now, price will likely sideways for a while. If you're able to break above the $1.04 level, I think we could see some short-term rebound to probably test 107 to 108, which is the current resistance for now, given that it was a previous resistance then turned into support, which actually broke down recently, that will turn back into resistance upon a retest. Next one is Food Empire. Okay, for Food Empire, I think for now the bullish momentum is still pretty intact. We are trading we are trading above an uptrend channel over here. And also previously there was a sideways consolidation for a while, and then we actually broke above it recently. Then we held the retest at $1. So for now, it's still okay as long as $1 still holds. For now, maybe we could see some form of consolidation for now. Yeah, given that price, we're seeing a little bit of sideways direction also. But looking at the MACD, we are seeing a lower high being made over here when price actually made a higher high. So there's some form of bearish divergence to take note. So if price breaks below $1, then that might be something to take note of as a sign of caution. But if the price is still holding at this support level, then I think it's still fine for now. The next one is Yangzijiang Shipbuilding. So for Yangzijiang Shipbuilding, recently we broke above a resistance level which is at around $1.23. Then price has moved upwards to test near the next resistance level, which is around 130 over here. So I think at this level we should find some form of resistance for now. But if we do a retest of this 123 level, we should find some support. I think probably we see some form of consolidation over here if for time being. Okay, next one is the three local banks. So I'll start with DBS first. For DBS currently, I think we could see some form of rebound given that the $30.50 level has held as a support. So we actually tested it twice recently, and price is still holding. And then looks like we are above these downtrend resistance lines for now. So if that holds, I think price could do some form of short-term rebound to test this previous support that we actually broke down from, which is around $31.50. Then we might see some form of range for now as we sort of bounce from the recent downtrend movement. And next one is OUB. OUB currently we are still the price didn't go back to the level which is near $27, which was a low back in March. Currently, price there was a breakdown below 27.80, then recovered back. So if you do stay above this level, right, I think there could be some short-term rebound as well. If you do break above this downtrend resistance line also, then the near-term resistance is likely to be around close to 28.40, which is this recent highs over here. And for OCBC, you can see from the chart, it looks a very well defined range pattern over here. So the support at near $12.10 is still holding well over here. So likely we see some short bounce to test the range resistance, which is near 12.45 to about 12.50 over here for OCBC. Okay, then for CLAS, which is a CapitaLand Escort Trust, I think recently price has found support upon a retest of $1.03. So this $1.03 was a previous resistance over here that we broke out of, and then there was a positive retest that took place last week. So I think for now, I think price could bounce up back to test the resistance over here, which is near $1.09 to about $1.10, which will constitute probably a trading range for now. Then if price goes above $1.10, there's also resistance at $1.12 to take note, which was the high back in February of this year. Okay, next will be some Hong Kong counters. So 3032, Hang Seng Investment Management Tech ETF. I think for now, it's still the outlook is still the same. Probably some range trading going on. We see a well-defined range over here. The support is still at around 375. Resistance is close to 4 over here. So for now, I think it's still range trading unless we break above these recent highs as well as this downtrend resistance line over here. Then that will probably take us maybe to attempt closer to 4.2 over here if we do see a breakout of this range. Next is Tencent. So Tencent, I think for now the price is still holding at near the 330 level, which was the March lows. So for now, looks like a bit of range trading going on, which we should see resistance coming close to about 345 to 350 over here, which is the recent highs. Then we are also currently trading, looks like to be in a downtrend channel formation currently as well. So there's this trendline resistance, there's this confluence of the trendline resistance as well as this horizontal resistance over here. So probably some range trading to be expected for Tencent currently as well. Then for JD, I think JD currently we are seeing also a range. Currently there's resistance at around close to $149, $150, which was these previous highs at mid-April over here. Then we actually we tested recently and then we pulled back from here. So for now, support is likely to be at two levels. The first one being 130, near 137, which was a previous low back in October last year. Then another support to take note of will be around 100, close to 132, 133 over here, which has held a few times recently. So I think probably just continue some range trading for now for JD as well. And next will be Ping An Insurance. Okay, for Ping An Insurance, I think we are probably trading in a broadening wedge pattern over here. Currently, momentum is down as we actually pulled back from the wedge resistance. But currently, I think we should be finding some support around $54 around this area, as is the wedge support, as well as looks like it's the wedge support. And if we do break out of this short-term downtrend channel, I think we could see some price rebound. If it goes above $56, then the resistance level likely to be at $58 to about $59 currently. Okay, any views on ST Engineering and UMS? Okay, for the chart wise, I think ST Engineering currently we actually break above this descending triangle pattern. Then we are sort of sideways at the previous high of January this year, which is around 376. So if we can break up, so currently there's some resistance over here. But if we can break above it, I think we could see somewhere closer to a previous retest of a previous support, which was broken down, which is around 385 to about 388 over here. So for now, ST Engineering, I think is still bullish for now. But for UMS currently, I think we could see some form of still a little bit of a pullback for now, given that we're actually still in a downtrend. Then we're also in this downtrend channel. So what we did recently was a retest of a previous horizontal resistance level around 90 cents. Then we actually bounced from here, but we back to retesting 99 cents, which was this support level that we broke down off. So coupled with this trendline resistance over here, I think for now we could see a little bit of range trading over here. Yeah, then we see whether it's able to break out of this downtrend in the future. Okay, let me see what's the next question. What's the technicals for Franken? Okay, I think following Franken's business update, I think currently the downtrend is still strong over here. So last week we actually broke down below this previous support around 93 cents and we did a retest. Today we are down again. So we actually crossed below this previous support around 88.5 cents as well. So we need to see whether in the recent days it's able to recover back this level. If not, the downtrend is likely to continue. With the next, currently I think the next support level should be around close to about 84.5 cents, which is this horizontal level over here previously. So that probably is I think we see whether price is able to hold at this level. If not, I think the next lower level probably around closer to 81 cents, which is another horizontal level. Okay, next one, Jardine CNC. Okay, Jardine CNC, I think for now, it's still in an uptrend. We are trending up nicely over here. The next resistance level to take note of will probably be around closer to the previous swing high around $35.80. Then going further up, we also have possibly this trendline resistance over here as well. So that will pose some resistance probably around 36.20, which is this close to this high over here as well. For current support wise, I think will be this horizontal level that we broke out of, which is around $34.50 over here. Our next one will be Marco Polo Marine. Okay, Marco Polo Marine, I think for now it looks good. It actually broke out of this 4.8 cents resistance over here. So currently we are seeing a new recent highs currently. The resistance level, I think we can take reference probably from this uptrend channel resistance, which is tested multiple times and proved to be a good turning point. So for now, I think the resistance for now probably around could be around 5.8 cents over here if it does test the channel resistance again. Okay, there's a question from Ray. For bullish divergence, should one focus more on RSI or MACD? If RSI shows bullish divergence, but not from MACD perspective. For me personally, I would prefer both to show the same direction. But if I'm choose to focus on one, I think I'll choose MACD because MACD actually represents the more of the momentum. We see more, so it's more accurate description of the current momentum that's taking place in the price action. While RSI, we are looking more of whether it's more of overbought or oversold region. But we know that strong stocks can remain in overbought regions for a long time, as well as the weak stocks can remain in oversold regions for a long time as well. So that's probably a weaker technical indicator to use as compared to MACD, in my opinion. So I think if I'm choose to focus on one, I'll probably look at MACD more, whether it shows some divergence. Hopefully, if you want to get more confidence sensing, I think you can look at multiple time frames. Like apart from daily, you can look at 4 hours as well as the longer time frame, like a weekly. So if they're all aligned in the same direction, then I think that will give a more confident. That will make you feel more confident to probably enter in the trade. Yeah. Okay, next is Manulife REIT. So Manulife, I think still in a downtrend for now, some sideways direction. If we are able to break above this downtrend resistance line with the current resistance around, I think around close to the 15 cents mark, then I think we could see some short-term rebound take place to probably test this previous support that broke down, which is around close to the 16.8 cents level. Okay, then for digital core REIT, I think digital core REIT, we are seeing some support coming in upon the retest of the close to the 40.5 cents level. So with that, if price is able to get above probably 42.5 cents, I think we could see a retest of previous support that was broken down around 44 cents for now. And then for venture, Eventually, I think we are retesting the recent lows, previous lows at around close to $15, which was the March lows as well as October lows of last year. So I think if price is able to find some support, I think we should be able to see some form of rebound to possibly test the resistance closer to $15.70 over here. Given that the sell-off here was pretty sharp, we could expect similarly a kind of a sharp rebound if actually price recovers from this level, given that we actually tested the supports over here. Next one will be Thai beverage. Okay, for Thai beverage, I think the still in a downtrend over here, but price is currently looking to trade in a sideways direction. If the 57.5 cents level holds, with the current resistance closer to about the 60 cent mark, there's also this trendline resistance acting for now as well. So let's see whether price is able to continue to hold at this level. If not, I think the downtrend could continue to test the next supports, which range from about 54 cents to about 56 cents over here. The next will be China Aviation. I think China Aviation for now, we seeing some resistance on a retest of this downtrend resistance line around at the 93 cent mark. For now, I think for now we should be able to see some support if we do come down to test the recent lows are near the 87 cents level. Yeah, so let's see whether this holds, and probably see whether it tries to attempt, see whether you're able to attempt a breakout of this downtrend resistance line in the future for now. Then Delphi. Okay, I think Delphi for now we could see some resistance coming at around 145. So this is the uptrend channel resistance over here. Then previously, when I look at the historical data, okay, back in 2016, you can see this was 145 was the previous support over here. So you can conclude that it's a key horizontal level, and looks like currently we are seeing a little bit of pullback for now. So, but the uptrend is still intact as long as we stay above in this channel, where the current support is closer to about 132 to about 135 over here. So probably just a short-term pullback. If this is able to find some support, then I think we could see the uptrend continuing for Delphi. Okay, next will be Propnex. I think Propnex for now we could see some probably some range trading, given that price actually came back from this big spike over here outside of the uptrend channel. So we came back into the uptrend channel over here, likely to find some resistance close to about 106 over here. But support we can see is coming close to about 96 to about 97 cents over here. So I expect probably some range trading over here as we revert back to some smaller volatility from the big volatility seen over here. And next will be AEM. Okay, I think for AEM, we are currently finding some support at the uptrend channel over here, which is in blue. So at around the $3.10 mark, we are seeing some support. So price is currently retesting around 326, 327, which was this previous support that we broke down. So likely to be some resistance for now, but we could see some support coming close to about 315 if the uptrend channel holds. So probably some range trading over here. Then we see what happens if it's able to maintain the uptrend channel or if it's unable to do so. And then for Semcom industry, I think for now is very strong. It's trading above this trend line resistance over here. It's also the new highs. So for resistance wise, probably it could go higher for now. But yeah, if it does a pullback, I think for now, some support probably expected near 460, around 465 to about 470 over here, which is this resistance we broke out of over here. Okay, next one will be Best World. I think Best World for now, we can see it's still in a downtrend. There's some support coming in close to 186. Then we had a bounce previously to about $2.02. For now, we are testing this level. There could be some support coming in. Something to take note as well. There was previously support around. There was previous resistance at 183 as well, which was this horizontal resistance. So I would think that 183 to about 187 over here would be a support for Best World if you see some bullish candles coming in. Then for now, resistance, I think probably close to the $2 mark, which is covering this recent highs, as well as this downtrend resistance line over here as well. Okay, next one is Olam. I think Olam for now looks a bit of a range over here. So the chart over here looks similar to something we've seen over here as well. So I think the support is likely to be near around 147, 48. Current resistance will likely be at 152, 153, this level that broke down off recently. But if we still hold at this level, I think we could see some rebound to possibly continuing the range trade for now. Okay, there's a question. Is the recent rally in US equities expected to continue? Okay, let me just take a look at the charts. And for Nasdaq, I think for now, there could be some resistance coming in around this level, around the 12.6K level, which was a previous swing level back in August of last year. So on Friday, we saw there's a small break candle coming in. But if we do clear, it's still possible that we do clear this level and possibly continue and go higher to test the next swing high, which is around close to 13.1 to 13.2K. So for now, I think we need to see the reaction at the start of this week to this swing high level. If we do pull back significantly for now, I think then this is a key level. If not, if we do break above this, then I think the uptrend is still continuing. So I think it's still early to tell whether this is the top, this is the high for now. And it's still possible that the rally is able to continue. And look at S&P 500. S&P 500, we did retest 4,002, which is this recent key resistance back in February of this year. We also closed with a slight bearish candle on Friday, but it's entirely possible that we still continue rally upwards. To if we do so, then we likely to test this highs around 4,320. Yeah, but 4,200 for now is there is a resistance level we see previously was a swing high level over here and over here as well, and we tested it on Thursday, Friday again. So similar to Nasdaq, I think we need to see where for now how the reaction to this resistance level is at the start of this trading week. One trade CCP for these holdings. I hope I got the counter correct because this looks a little bit illiquid. So I think for now looks like this counter is probably trading pretty much in a range. Over here we can see that there's resistance. The next resistance is likely to be around 16.7 cents. Then the next one is around 17.8 cents over here. Current support is, you can see, is coming in around close to the 13.5 cents to about 14 cents region over here. Yeah, probably move on to the other counters, which is Prime US. Okay, for I think for Prime, looks like it's seeing some rebound at for now, since we actually tested this channel support over here, which is around the 20.5 cents level. Then I think I saw on the RSI and as well as MEC, there's actually like a triple bottom pattern taking place as well. So for now, I think we should see some short-term rebound continue to test this trendline resistance over here, which is quite near. I think it's around 23.5 cents over here. Then we should expect some resistance for now. Going further up, there's also resistance likely to be at 25 cents level, which is this previous support that was being broken. Then while current support will probably be around 21 cents to about 21.5 cents over here, which is this level that we broke above recently. Okay, for Suntec REIT, I think for now, it's looking a little bit bearish for now, given that it actually broke down this main uptrend channel. Then another thing is that actually broke below this the previous swing low levels, which is around 135 to 136, which posted in February this year. So price may actually trade lower to possibly retest this next lower swing low supports around 130 over here. The next one is Raffles Medical. Okay, so for Raffles Medical, I think we are retesting this uptrend channel, sorry, not channel, uptrend line support again around 137. So we need to see price is able to hold over here and rebound for this longer term uptrend to actually continue. If not, we could be seeing a little bit of a reversal and for now. Then the next support to take note, if we can't hold at these levels, will probably be swing low at around close to 130 over here. For now, I think resistance likely to be at around 139 to about 140, which is this swing highs and these previous these swing highs over here, as well as the previous swing low support over here. Okay, I think that's all for me for TA today. There's another webinar coming out at 1 o'clock if you are interested to join that. So I'll pass my time to the rest of my colleagues if they have anything else.
Yeah, Zane, thanks for the TA portion. We have another Singapore Depository Receipt SDR briefing coming up immediately after this. I've placed the registration link at inside the chat, so I'll leave it there for about 20 seconds before I'll close this webinar. Yeah, thanks for joining us again as usual. We hope to see you next week. Yeah, so I'll just leave the link there for a bit. Thank you. Yeah, okay. Then with then hopefully those who want to attend already got the link. Yeah, so I'll just close the webinar now. Thank you and have a great day ahead. Bye bye.